You know that feeling, right? You enter a trade just as the momentum looks absolutely perfect, only to watch the price instantly reverse and smash right into your stop loss. It's incredibly frustrating. So, how exactly do you filter out all that daily market noise and stop getting trapped by those fake breakouts? Well, that is exactly what we're going to solve today. Welcome to today's explainer. Today, we are decoding a highly structured, math-based approach called the QQE plus volume-weighted quant algo. Listen, this isn't about guessing, and it's definitely not about relying on gut feelings. It's a complete, combined strategy designed from the ground up specifically for high-probability trend trades. Here is our quick roadmap for today. First, the engine. Second, the parts. Third, the triggers. Fourth, the operation. And finally, number 5, the safety manual. All right, let's jump straight into part 1, the engine. This is our core strategy philosophy. The entire system is built on marrying two incredibly powerful forces in the market: smart momentum and actual institutional volume. Think about it like this. Momentum tells you a car is moving fast, but volume tells you if there's actually a heavy, powerful engine under the hood driving that speed. We are looking for those exact moments when high probability momentum perfectly aligns with real, heavy institutional money flowing into the market. So the crucial point here is how we divide the labor between our tools. We aren't just slapping random lines on a chart hoping something works. Every single indicator has a very specific job. The QQE indicator confirms our momentum. The VWAP confirms the institutional bias. The volume confirms actual real-world market participation. And the EMA, that confirms our overall trend direction. They all work together as one synchronized team. Moving right along to part 2, the parts. Let's actually decode these indicators. So the real star of the show here is QQE, which stands for Quantitative Qualitative Estimation. I know, it sounds super complex, but at its core, it's just an advanced, much smarter version of the traditional RSI. It uses Wilder's moving average for smoothing and applies average true range, or ATR, to filter out all that raw market volatility and noise. So instead of jumping all over the place like a standard oscillator, it cleanly identifies trend strength and potential reversals. And you can actually see the math visually represented right here. Notice those dynamic ATR-based trailing bands wrapping around the smoothed RSI line? When that RSI line actually crosses above or below those trailing bands, it generates highly accurate cross signals directly on the chart itself. It gives you this perfect visual cue for a potential reversal or continuation, which completely keeps your focus locked onto high probability setups. But here is where most traders fail. They trade momentum in isolation. In our algorithm, those smart momentum signals from the QQE absolutely must be validated by heavy institutional footprints. We track those footprints using the volume-weighted average price, the VWAP, alongside relative volume spikes. Listen, if QQE says buy but the VWAP and volume are quiet, we just sit on our hands. The smart money simply isn't there yet. Okay, if you're following along on your charting software at home, here are the exact tools and settings you're going to need to plug in. For QQE, use an RSI period of 14, a smoothing of 5, and an ATR multiplier factor of 4.236. Then you'll also need to add your standard VWAP, a 50-period exponential moving average, and either your relative volume or a 20-period volume moving average. Got it? Awesome. Which brings us to part 3, the triggers. Let's go over our strict buy and sell rules. I want you to think of these conditions as a series of traffic lights. Every single one must turn green before you hit the gas and execute a trade. Let's walk through the exact buy setup checklist. Light number 1, price must be trading above the VWAP. Light 2, price must be above the 50 EMA. Light 3, the QQE must have a bullish crossover above the 50 center line. Light 4, we need to see a volume spike clearly above the average. And finally, the trigger itself, a strong bullish breakout candle. If even a single one of these conditions is missing, the setup is entirely invalid. You do not trade. On the flip side, the sell setup requires the exact inverse rules. You're looking for the price to be below the VWAP and below the 50 EMA. You need a QQE bearish crossover below that 50 level, accompanied by heavy selling volume and validated by a strong bearish breakdown candle. By forcing yourself to literally check off every single box, you completely remove the emotion and the guesswork from shorting the market. All right, moving to part 4, the operation. Let's talk about the professional workflow. A pro follows a strict chronological life cycle for every single trade. Step 1. Check the overall market trend using the EMA. Step 2. Check the price relative to the VWAP position. Step 3. Patiently wait for that QQE crossover to happen. Step 4. Verify the volume spike. And step 5. Actually, let me really emphasize this one. You wait to execute only after the candle closes. Seriously, do not jump in while the candle is still forming, because that is exactly how fakeouts happen. Wait for the definitive close. What makes this specific strategy so incredible is its versatility across entirely different environments. If you're a scalper, you can easily use the 3-minute or 5-minute charts. For your standard intraday day trading, the 15-minute is pretty much ideal. And if you are more of a swing trader, you can absolutely apply this to the 1-hour or 4-hour charts. It works exceptionally well across the Nifty, Bank Nifty, large cap equities, and yep, even the crypto markets. Finally, we reach part 5, the safety manual, our risk management rules. Rule number 1, and this is non-negotiable. Your absolute maximum risk per trade should never ever exceed 1 to 2% of your total account balance. Look, it really doesn't matter how perfect the QQE cross looks or how massive the volume spike is. You absolutely must protect your downside strictly at 1 to 2%. Rule number 2 is all about your mathematical edge, and that's a minimum risk to reward ratio of 1 to 2. For every single dollar you risk, you must be targeting at least $2 in profit. By adhering to this ratio, you basically ensure that over a series of trades, your winning setups mathematically outpace your inevitable losing ones. And speaking of those losing trades, having tight stop losses is completely required. Just place your stop loss logically below the recent swing low for a buy or above the swing high for a sell. Oh, and one more thing. Remember that this algorithm thrives in trending conditions. You have to actively avoid overtrading when the market is just chopping sideways in a tight, boring range. So when you put all of these moving parts together, the advantages of this system become pretty obvious. It systematically filters out those annoying fake breakouts. It essentially forces you to only take trades where momentum is backed by heavy institutional activity. It drastically improves your overall trend accuracy, making it just an absolutely brilliant, comprehensive framework for momentum trading. If you take absolutely nothing else away from this explainer today, I want you to burn this single sentence in your mind. Trade only when momentum and volume agree. That's it. That is the ultimate takeaway. That is the real secret to stepping out of the noise and aligning yourself with the smart money. So I'll leave you with this final thought. We've given you the math, the indicators, the strict entry rules, and the risk management protocols, but at the end of the day, the algorithm only works if you let it. Will you have the discipline to wait patiently for all the traffic lights to turn perfectly green before you execute your very next trade? Let that question guide your next session. Thanks so much for joining me on this deep dive, and keep learning.